Welcome back to the overview of my financial literacy series titled What You Don't Know Will Hurt You, which identifies extremely important financial issues that most people aren't aware of. My name is Brian Kempton, and the next installment in this series is taxes, which are one of the three big pipes draining your dream tank. We're going to do this in two parts. Part one deals with personal taxes, followed in part two with investment taxes. Taxes are part of virtually every financial transaction you make. They eat up a third of your income, which makes it just that much harder to work your way upriver. While everyone is fully aware of federal and state income taxes, there are many less visible fees and taxes out there. By the way, fees are essentially taxes, such as these items. I was shocked to learn that the total you're now paying in taxes exceeds what you're paying for food and clothing combined. The good news is that you can lower your tax bill, both legally and ethically. Tax literacy is knowing how to do this. Were you aware that there are two tax structures in the U.S.? The first taxes your money as you earn it. Then you are allowed to spend whatever is left over. The second tax structure allows you to spend your money first, and then you are taxed on what you have left over. If you can legitimately spend all of your money, then you won't have to pay any taxes. The first tax structure is the W-2 employee. I'm sure you've noticed all of the taxes taken out of your paycheck before you even saw it. The second tax structure is for the business owner, who is allowed to first spend money on his or her business and then is taxed on what's left. You'd be surprised what you can legitimately claim as a business expense. For example, a business owner is allowed to deduct over 50 cents a mile for any miles traveled for business purposes. This can legitimately include driving 1,000 miles to visit family as long as you conduct some legitimate business while you are there. So the first question is usually, how does that help me? The answer is found in the types of businesses available to you. This chart was created by Robert Kiyosaki and is fully explained in his book, Cashflow Quadrants. The E quadrant contains employees, in particular the W-2 employee. The S quadrant is for all those who are self-employed, like 1099 contractors, doctors, plumbers, and dentists. Everyone on this side of the quadrant is trading time for money, meaning they only get paid if they carry their bucket to where they work, get it filled with liquid assets, money, and then carry it back home. 95% of all workers are on this side of the quadrant. The worst of it is that they are competing for only 5% of the available wealth. The B quadrant is home to the B-type business owners. And finally, the I quadrant is where the real investors hang out, not people with an IRA, 401k, or a few dollars in the market. This is where Warren Buffett and those like him can be found. They are all receiving residual income as represented by the pipe that carries their liquid assets, even when the business owner or investor is away on vacation or asleep. This side of the graph is home to only 5% of the workers and 95% of the wealth. Between the tax advantage and the residual income, it seems to make sense to become a business owner. But how do you do that? Isn't it costly and risky? Let's take a look at the aspects of getting a B-type business of your own. Remember, a residual or B-type business has to be something that makes money even when you aren't working, which rules out self-employment. First, let's look at cost, which could be in the tens of thousands of dollars to set up and operate your own business in a rented space, even more if you build. Buying a franchise could cost you millions. or you could go with that class of businesses that cost only a few $100s. The next is risk. As in anything that you do in life, there is a possibility of failure. In business, one might say that there is a probability of failure. However, there are specific things that one can do to probably not fail. To start with, you can invest in yourself by becoming financially literate and learning why most businesses fail. And you can pick the kind of business that will probably succeed. The final element that we need to talk about and deal with is government regulations. How much and how bad also depends on the type of business that you choose. So, what is the easiest, safest, and cheapest business to get into? You're not going to like the answer, but it's actually direct sales, meaning people to people. I know how you probably feel about this answer because I felt the same way until I did some studying on the subject. I realized that going this route is actually genius for several reasons, including the 75% probability of success. First, I realized that I don't have to deal with the government because the parent company does that for me. Second, the parent company also does all the heavy lifting like bookkeeping and payroll, which frees me up to work the business. If you pick the right company, then the risk and the cost is typically well under the other options. The key is to pick a reputable company. I wouldn't be much of a coach if I couldn't help with that. A big surprise to me was when I learned that direct sales is a $1 billion industry, which gives it a little more legitimacy. We've talked about reducing your income taxes by becoming a business owner. Next, we will be looking at reducing taxes on your investment. With that unexpected revelation about direct sales, we've come to an end in part one. In part two, we will be talking about how investments are taxed. Here's my contact information. You can stop the presentation if you need time to write it down or to click on the QR code. And once again, thank you so much for listening.